Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, defense companies adapting to dramatic changes in warfare. We'll look at opportunities for investors. Plus, fallout from Magnificent Seven earnings and opportunities in old school tech. We begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Teresa Rivas, and Jack Howe. So, Ben, if markets were in the mood to worry, there are a lot of headlines that could have worried investors this week, but instead we just kept on marching higher.
Really, we did. And it was all about earnings. And to put in the words of Metallica, nothing else matters. We had oil gain almost 8% this week. I shrugged it off. We had earnings from Microsoft and Meta that were not met very well by the market. Who cares? Even had a Fed who not only did we not get a rate cut, and we're not going to get a rate cut, we're getting Powell staying on the Federal Reserve after his term ends. That didn't get a reaction. What did get a reaction was just great earnings from companies across the board, especially from a lot of other tech companies.
It's possible the market thought that Powell thing was actually a good move for now. We'll see what happens. Some of the numbers in those earnings reports were stunning. Google Cloud grew by 63%. Its backlog is almost $500 billion. Just extra. Amazon growth was incredible. What do you make of all that? I guess that's what's driving the market, right? The GDP report, in fact, suggested that almost all of our growth is coming from AI.
That's right. I mean, you hear a lot that tech investors don't know what they want from the companies. I think they know exactly what they want. They want tech companies to make money with AI. So you get a Meta, you get a Microsoft, they're spending a ton, but they're not making anything. Their stocks drop. But then you get Alphabet, who's spending a ton, but actually making a ton, and their stock goes up. And now that money that's being spent is also hitting other companies, things like Quanta Services, Amphenol, which makes electronic connectors, even Caterpillar, not from machinery, but from the turbines they make that are going into powering things. These stocks are doing well, too, because of all that spending. It's pretty amazing.
A strategist I spoke with this week said what's unusual about the blowout earnings is that companies are more bullish than the analysts. Usually it's the opposite. Companies are saying we can grow by 125%. Analysts are saying that sounds bananas. We'll say 75%. That's why they keep having to ratchet the earnings estimates higher.
And what's amazing is you're seeing the price targets go up too. SanDisk went from 1,000 to 2,000 from one analyst, but it had nothing to do with valuation. It was all because the profits are going to double as well. It's absolutely incredible.
Yeah, valuations are falling while these prices skyrocket. So next week we got a lot happening. We'll get the jobs report. That'll be the first one for Kevin Warsh to officially respond to. You've got lots more earnings. Palantir, Disney. What are you watching carefully?
I think the jobs report is going to be interesting. It's going to be their next reading, but for right now, if things just hold up okay, this market has no place to go but up.
All righty. Speaking of up, Jack, in the month of April, Intel shares were up 114%. Who needs NVIDIA?
I mean, when it's coming around to Intel, you know something big is going on. The AI updraft is definitely breathing new life into old tech. D.A. Davidson summed things up nicely this past week in an initiation report on Micron Technology. That stock is up 600% a year. They make memory. It's actually still a third cheapest in the S&P 500 relative to earnings because the earnings are rising so quickly. They say what investors are getting wrong is how long this cycle can last. As hyperscale data center companies put more chips and memory in these centers, the bots that do coding or drug discovery, they figure out new things that they can do, and that makes new use cases, and that creates new demand. That cycle won't last forever, but they think it can extend to the end of the decade. It's creating a positive feedback loop. It's hit memory, it's hit hard drives, and now you can add Intel and Dell and Hewlett-Packard Enterprise because AI needs lots of traditional servers too. Don't forget, the U.S. government took a 10% stake in Intel back in August. President Trump posted on Truth Social this past week, I am responsible for making the United States of America over $30 billion in the last 90 days on that stock alone. I would have put a few rocket ship emojis there, but I'm not going to tell the president how to Truth Social.
And that's one way to get rid of the debt.
Right. Interesting context for Intel. Incredible April. If you bought on August 31st, 2000, you also made about 114% over 26 years. Teresa, Citigroup is going to host an investor day on Thursday. That's often kind of bullish for the stock. Barron's cover story was a deep dive into the stock. We sat down with Jane Fraser, other big executives there. What did we find out?
So Jane Fraser has been CEO for about 5 years, and she's making headway. The stock is at a 17-year high. Year to date, it's doing better than peers like JP Morgan, Bank of America, Wells Fargo, and she's made real progress. Metrics like return on tangible common equity is over 13% as of the first quarter. It's the first time it's been that high in more than a decade.
Well, speaking of more than a decade, that is a hideous, hideous chart. The Barron story actually describes Citi as a 2-decade wealth destruction machine. Are we bullish that 2-decade run is over?
Well, as you point out, it's not a good chart, and it's actually the only major bank that's trading below where it was before the financial crisis, so not great. In the article, Jane Fraser says proudly that she's Scottish and cheap, and that could be a good thing because I think she's still going to have to do more cost cutting, preside over more layoffs, but also spending money too. They need to attract more talent.
And I think the thing that's great about a chart like that, yes, it's ugly, but if you look at all the room that it has to go up, you got to love the potential there.
That's optimism, right? Yeah. Who wants something that's done well? You want something that's done badly. Buy cheap. Thanks, guys.